Private lenders versus banks. I'm really excited about this, and I think I could answer your questions. Private means it's just not an institution, it's from an individual. So, private lender for us, we've got some family members that are private lenders, we've got some friends that are private lenders, and it just means that they're not out there lending to the public. They are not an institution that is giving you a product. They are an individual that you likely have a good relationship with, that has a lot of money in like a 401k, a retirement account, a savings account, and they do not want to put that money into the stock market or into any publicly traded company or any other kind of government sponsored retirement vehicle or public offering, because they just don't trust it. Because at the end of the day, all these companies operate on trust, and whether or not your money increases or decreases is based on the performance of that individual that you have no say in, that you can't come in and fix. A lot of people are still scarred from 2008, where they lost almost all of their money and there was no one there to be held accountable. Everybody just said, sorry, you knew the risks, you shouldn't have invested money that you couldn't afford to lose. And that's not the right way to respond. And when you are an individual that doesn't want to invest in that, you can become a private lender. And there are some alternatives to those types of investments, where you can invest in business owners that that you have a relationship with. You can invest in some real estate investors that are fixing homes in your local community where there is an asset as collateral, which is kind of how we structure a lot of our loans. Is when people lend us money, it's secured via a first position mortgage on that property. So if for whatever reason we have to default on the payment, then they have the right to foreclose on that property or to accept title to that property, to kind of circumvent that foreclosure process in lieu of the debt. So that is inherently different than this, sorry, you knew the risks, you shouldn't have invested money you could afford to lose. Because it's saying, hey, if we don't perform the way that we said we would, then you get this house. And I think it's pretty cool because the formula that we use is purchase price plus rehab costs is equal to or lesser than 75% of the after repair value. So if a property's after repair value is $100,000, then we're not going to borrow more than 75,000 against it. So our purchase price plus the rehab costs have to equal 75,000 or less. So in the event that, let's say, we borrow 75,000 and we're not able to make good on those payment terms, well, that private lender gets an asset that is actually worth 100,000, which is almost the exact opposite of what the traditional kind of stocks or investment vehicles that are offered do, where they just say, sorry, I did not mean to lose all of your money, but you knew the risks. I don't like that setup at all. So when it comes to being a private lender versus using banks, private lenders versus banks, it's not a either or, and I wouldn't even call it a versus. It's how can you make the most amount of use of both of them? How can you use them to really bring your business full circle? And I will share with you when we use private lenders and when we use banks. And our entire business model revolves around using private lenders to acquire and rehab properties. And I just shared the formula where purchase price plus rehab costs equals 75% or less of the after repair value. So already each property that we purchase, we want to have 25% equity in the property at the time of purchase. Now, what this does is it allows us to later, when the property is rented, when it's in great shape, when banks would love to be a part of it, we're able to take this property to a traditional bank, to a traditional lender. They're the ones that have the longest term and the cheapest capital. And we refinance with them. Most banks like to do 75% loan to value. So that allows us to just kind of swap out the bank's money with the private lender money. So we pay off that first position mortgage. We now have a first position mortgage with the bank, and it's amortized over 20 or 30 years at a lower rate than the private lender's funds. So now, because that private lender appreciates getting a higher percent interest, that 10, 12% interest mark, they want to deploy their money again. What does that give you the opportunity to do? Go out and deploy that $75,000 again. And then you can continue doing that. So you've got one asset that's performing, it's rented out, it's cash flowing, it's on a 20, 30-year low interest rate mortgage payment. It's, principal's getting paid off every month. Your equity's building, your appreciation's going up, you're getting some tax benefits from all that interest you're paying. And then you're able to take all of the private lender capital that you used for that first deal and turn it over to a second deal. And, as far as private lenders go, I would differentiate between kind of private lenders and hard money lenders. I would say private lenders are people that that you have relationships with. It's kind of money that you have found yourself. Hard money, I would say, is the more institutional side of private lending, where you don't have relationships with the end users, or the end lenders. You are using somebody that has the relationships with all the private lenders, and they will likely charge you some origination points. I've heard as high as like 4 points to close a deal. So if you're borrowing $100,000, they're going to charge you $4,000 just to get you the funds, and that could eat up a lot of your profit really quickly. So using hard money to take down a deal, if the numbers make sense and you're able to pay those fees, is definitely something that you should do, especially if you've got enough equity to replace the hard money lender funds with a traditional bank later on and not come out of pocket. I think that is still something that you should do. However, if you have the time, the energy, the effort, the desire to find your own private lenders through relationships, through educating, the friends and family members that you have that have retirement funds that they don't want to put into the stock market, coach them through finding alternative ways to lend out their money to people like yourself, then you don't have points. You don't have fees that you need to pay. You just make those interest only payments and you're good to go. Now, with private lenders, I will say generally it's a short term kind of balloon payment. So 2 years, 3 years, 4 years, whatever you and the private lender decide on is what you can ink into existence, truly. So if you have a 2-year balloon payment, the only concern that you have is not necessarily the cash flow during the 2 years of you having that private lender funds, but making sure that you have the ability to refinance inside of those 2 years before that balloon payment is due. So a lot of the deals explained videos that I did at first, I get a lot of comments saying this is a horrible deal. It doesn't cash flow, because sometimes, if a property is in an area that we like, if it is really high equity, but if the rent is low because it's, an inherited tenant, somebody that's lived there for 15, 20 years, there might be like a negative $50 per month cash flow. And people in the comments will say, hey, that's a horrible deal. Well, it isn't really, because, the loan that is negative $50 per month is 2 years. And there is, 30, 40, $50,000 of equity on that deal. And when you refinance into a lower interest rate that's not the 10 or 12% from a private lender, it's a 4, 6, 7, 8% now. The numbers get higher as the government does its thing. So, or the Federal Reserve, whatever. So when you replace that fund with like traditional finance, then that monthly payment changes, and you have the ability to start cash flowing just from making that refinance. And then you also have the ability to improve the property, to raise the rents on the property, and work on that actual asset in order to increase that cash flow. So one thing that I would say is never extend yourself from a private lender perspective to where you can't afford any loss that you might be taking. And I'm not advocating for people to, analyze these properties and take loss just to get their foot in the door on deals. Obviously, we shoot for, $50 to $100 per month in positive cash flow as we're analyzing these properties, even with private lending. However, sometimes it does make sense to have negative cash flow on a property as you're getting your foot in the door, and don't let that deter you from executing on that deal because you see the negative cash flow if you have high equity and a short term, 2-3 year plan of getting that transitioned over into long-term financing. So when it comes to private lenders versus banks, I would say analyze any deal that you're interested in utilizing both of those. Analyze, see how it performs on the 10 to 12% interest rate, have a game plan to 2-3 years from now, refinance into a traditional mortgage, and figure out how the property is going to perform then. And don't overlook the fact that you do, in fact, have the ability to raise rents to improve the property. I would say as markets change, you hear a lot of people say, well, hey, what if your note is called? That's one of the biggest things that I get as I'm explaining our business model. And like, hey, what happens if like this 2008 style thing happens and all of your notes get called? Well, you should take a look at your 20 to 30 year notes that you're doing. You should call the banks. You should look at the Fannie and Freddie 30-year mortgage terms and figure out who has the ability to call a 20 or 30-year mortgage. The 20 to 30-year mortgages, those are not the loans that are called given volatile marketing conditions. You've not heard that. Actually, one of the risks that these traditional banks take on when they're making these mortgage is, the interest risk. If interest rates decline after they make those loans or increase after they make the loans, then they're not making as much money as they could. That's something that they do. But these institutions have so many funds that they just need to lend them. Now, lines of credits, more short-term debt vehicles, private lenders, on 2-3 year balloon payments, those are the notes that get called. Those are the ones that react very quickly to market conditions. So as soon as you have a property on a 20 to 30 year mortgage, you should consider yourself to be home safe. So if you're going to utilize higher interest short-term debt in order to acquire and or rehab properties, then you should always be in a race to get these properties on long-term financing. And as soon as you achieve that, you should consider yourself to be home safe. All you need to do at that point is make sure that the asset stays rented out, that you continue to address deferred maintenance as it arises, and that you keep positive cash flow on that property. But as far as market volatility, as far as notes getting called, doesn't quite exist on a 20 to 30 year mortgage.
Thanks for watching that clip. I thought that was a good question. And I think you can ask good questions too. Join us every Friday morning at 8 a.m. Eastern Standard Time for a live stream Q&A where we answer plenty of questions just like this one. In the meantime, consider subscribing to the channel if you want more of this content. And if you want to increase your deal flow, analyze properties better, and help me feed my family, click the link below for a free 7-day trial of PropStream.